Hi, Phil. Happy New Year.
Hi, Todd. Happy New Year to you too, and thank you for doing this.
Absolutely happy to be here. So we're filming this in late December. About a month ago, Benj and I had a discussion discussing his tax loss selling strategy. Do you have a similar philosophy, or do you partake in that as well?
Yeah, I do, and in general, I think it is a good strategy, and it's a good strategy because it allows us as contrarian investors to squeeze out an extra percent return or two, which helps over the long run. And that's because tax loss selling is a form of forced selling. So people are going to go into year end and they are going to just dump any losers. And as people like us who are looking for contrarian companies, beaten up companies, that's a perfect way to supplement our return. And then generally speaking, once the tax loss selling stops in the new year or at the end of December, there's a little pop in the shares. So that helps. And I like it. So yes, I do participate. The downside, of course, or the potential problem to look out for is sometimes weak companies are weak for a reason, and they can keep losing into the new year. So what looks like a tax loss selling bargain might just be a bad investment, and that's where analysis really comes into play.
Right. Good point. Good. So were you active this tax loss selling season at all? Or?
I think we were. I think it was more active than some of the more recent years anyway. In the vice president's portfolio, we bought two new Canadian names. We added to two existing Canadian positions, and then we also added to a U.S. existing position, and we took on a new U.S. position. And for us, that's a lot. I know there are day traders out there who are trading that much in an hour or something like that, but we're not day traders, and for us, that's quite a bit of buying over a, say, month and a bit period.
Yeah. No. Good point. So do you have you still retained enough cash that if the markets turn down at some point, you'll be in a good position, or how have you navigated that?
Yeah, that's a good question, and I think so. I'm comfortable with the cash position, and I look forward to downturns as a result, but it is tough to know how much cash to hold right now. On the one hand, you have very high valuations, or rich valuations, I would say. Debt loads are high, lending standards are loose, and the economy is doing well. But then on the other side, inflation is high, and high inflation, and presumably at some point high interest rates that go with that, they chip away at the value of cash. And in that kind of environment, holding equities is better. So that's the balancing act that we, and I guess every investor, is trying to navigate. And unfortunately, we won't know if our strategy and if our cash rationale, as it stands right now, is good for a while yet.
Yeah. No. Good thoughts there for sure. So you said just thought it was interesting. You said we look forward to future downturns. That must put you in the minority of investors out there.
Yeah, it would put me in the minority of investors out there, I suppose. But if you think about it, incredible buying opportunities happen in downturns. Without downturns, you don't get those incredible buying opportunities. So, in general, you can find good companies to invest in at almost any given time. You can find good sectors, but it's really in those brutal bear markets that fortunes are made. And if I think back to March of 2020, for myself anyway, I was, when I look at the number of trades that happened in that month, it was more than any other month in my career. And that was just because everything was falling. So, I wasn't trying to bottom pick by any means, but things were just cheap. So I was trying to take advantage of that. And the trick, of course, when these big bad bear markets come is trying to keep your cool and try and think long term and keep your head. And everybody around you, the media, economists, you name it, they will all be saying don't do it. But you just gotta bite the bullet, I guess.
Yeah. No. Definitely. Yeah. Keeping you cool during downturn is certainly hard. Okay, so moving into company-specific questions here, we have one that's sort of on the inflation hedge theme to some degree. What are your thoughts on Century Aluminum?
Century. I would say it's a bit mixed on Century Aluminum. On the one hand, you're right. It could be a good inflation hedge because generally speaking, industrials are good inflation hedges versus, say, a consumer discretionary company. And value stocks are generally better than growth stocks in an inflationary environment. It's also very cyclical. The beta is high, so if you want to try and buy and sell and get in on that, it's good. And the price of aluminum is high and their operations are doing well. So all of those features suggest to me it's a good investment or it looks like a good company. But then on the other hand, although the price of aluminum is high, the price of their inputs are also high and they're also going up. So alumina, which is one of their key ingredients, those prices are going up. Power prices aren't going down. So that's a headwind. If the Chinese market, real estate market that is, falls apart, that would be a big blow to aluminum prices because China is such a big consumer of aluminum. And then in the background, behind all of this, their balance sheet isn't what it used to be. Since about mid-2019, they've been, management has been more comfortable with a higher net debt position. So they've lowered the amount of cash they're generally holding, and they've increased the amount of debt. And, given that it's such a highly cyclical company, that makes me a bit nervous to have a balance sheet that's not what it used to be.
Right. No, that makes sense. Yeah. A little bit of caution to be exercised there. So would you say this is a buy, sell, or hold for you then?
I would say it's a hold.
Okay, great. Perfect. Well, sticking with large and levered industrials here, we have a number of subscriber questions about Diana Shipping and the recent spin-off of OceanPal. Most of the questions have a common theme, sort of, do you have an updated sell target, and what's your outlook on it now? Can you comment?
Yeah, so I would say that the spin-off, it's now complete. I don't intend to update the sell target until the middle of 2022. I want to see how each company operates now that they are independent and reevaluate. And I think reevaluating Diana Shipping will be fairly easy. I know the company well and what their strategy is. But with OceanPal, I want to try and wrap my head around it first and see how they perform, see what their balance sheet is like. What I would say, though, is that these are two very different entities now. Diana Shipping has dozens of ships. They time charter out on a fixed rate, which is effectively a hedge, which smooths out the earnings volatility. But on the other hand, OceanPal, it has 3 ships, which is tiny, or at least that's where they're starting. And most of these ships, or all 3 of these ships, are going to be leased out on a spot market basis. So the earnings and cash flows that this company will generate will be much more volatile than Diana Shipping.
Right. Good points. So what are your thoughts on the spin-off in general here?
Well, I hope it works. I'm not sure about it, to be honest. The OceanPal fleet is so small. They intend to grow it, but growing a fleet is difficult because the price of ships is quite high and it takes time to grow. So, I wish them the best and I hope it works out. Obviously, I own the shares given that it was spun out of Diana, but we'll just see. And then in the background, I also think they used to have a similar situation or a similar spin-off or small company or subsidiary called Diana Container Shipping. And Diana Container Shipping, it was a publicly listed company and it flopped and it didn't do well at all. So I hope the same isn't going to repeat here, but I'm a little cautious for sure.
Yep, understandable. Okay, good. Well, switching to Canada for a minute, what are your thoughts on the Shaw-Rogers deal and the Rogers Family Feud here on full display?
Yeah, oh boy, that family feud was on full display for sure. For a family dispute like that to end up in court, it looks pretty ugly. And I know that it was just really, really public, which sucks for, I'm guessing, all the family members involved. But taking back a step, for me as an investor, I don't know if it particularly impacts the Shaw-Rogers deal or the proposed deal. Both warring sides of the family wanted this transaction to go through. And now that the family issue, has been resolved, or at least I assume it's resolved, my guess is they get on with the deal and they try to make that work.
Right, fair enough. Okay. Well, what about the argument that the family feud here really distracted both management teams from closing the deal?
Yeah, there's no doubt it must have been a distraction. I mean, how can you go to work and not have this overhang of what's happening in the courts and in the boardroom? But I think the issue here isn't pushing it across the finish line from a management point of view. It's getting regulatory buy-in. And to me, I don't think regulators really, it doesn't factor in that much. At least in theory, they're supposed to be worried about potential impacts on competition and consumer choice in Canada. And the fact that a family feud is going on within a boardroom, I don't think really changes that.
Right. No, that makes sense. I mean, what about the argument, though, that, the family rift shows the danger of consolidating power in a single company telecom power, I should say, within a single company that has a dual share class structure, which essentially means that you have one dysfunctional family controlling one of Canada's most important corporations. I mean,
Yeah, I think that's a really good point, and frankly, I agree with you there. And if regulators don't block this outright, I would hope that they eliminate the dual class share structure and effectively end the monopoly the Rogers family has over the control of Rogers, which is already a very big corporation, a very important corporation within the Canadian context. And if it merged with Shaw, obviously it would be an even bigger, more important corporation. So that's what I would hope happens. I would just kibosh this dual share structure and put an end to it. But I'm not a regulator, and no regulator has ever called me and asked me what to do. So I'm not about to hold my breath. I could easily see this being a perpetuated issue in a large merged company.
Yeah. Okay. Fair enough. So I think last time we spoke about this deal, I think you said you think it's going to go through regardless, despite there being very valid, or at least in your opinion, very valid reasons for it not to go through. Is that still how you feel?
Yeah, I would say more or less that is how I feel. The market is clearly expressing some concern or trepidation, I would say, given that the spread is about 8%, which for a merger is a fairly large spread. But I just think that Shaw and Rogers are both really powerful companies, and they will push or charm or do whatever they can to convince regulators to get the deal approved. And I know the Competition Bureau has had tons of feedback from the public and from other parties and other stakeholders about potential issues, but my guess is they just get it done. So one way or another, I guess they get it done. And in this country, and I guess in the U.S., we've really substituted church and state for corporation and state. I mean, the relationship is really cozy, and I think it probably goes through. They might have to eliminate a division or maybe get rid of this dual class share structure or spin something off, or who knows. But at the end of the day, I imagine we're going down to one less large telecom in this country.
Fair enough. Yeah, so I'm guessing you still own it with that 8% spread that...
Yeah, still own it, and we haven't really chatted about doing anything different.
Fair enough. Okay, great. Well, maybe sticking with corporate mergers for a moment, we have a question here about Sanderson Farms. Asks, do you still own Sanderson Farms, and what's your outlook now?
I do, yes. I still own Sanderson Farms, and I think the outlook is pretty good. For those who don't know, Sanderson Farms is a U.S. company. It's a poultry producer, and they own about or command about 9.5% of U.S. market share for the poultry industry. And last summer, Cargill and Continental Grains offered to take the company private at $203 per share in cash. So that's a pretty good deal. And the timeline for the close is mid-2022, and I took a position in the name at $187 and a few cents. So it's a respectable spread, and it comes with a little dividend too.
Great, okay. With a spread like that, there must be some wrinkle or risk to the deal. I mean, can you speak to that?
Yeah, for sure. You're right about that. And the risk here is antitrust review and passing regulatory muster or passing the regulatory review. As you know, inflation is running hot. Food prices are high, and this merger would see Sanderson Farms, or the merged company, go from about 9.5% market share to 14.5% market share. And there are politicians on both sides of the aisle that don't want to see industry consolidation. So that's the big risk. Aside from that, the deal is pretty straightforward. Financing is in place. It's a friendly deal. Shareholders are on board. And it came after a prolonged discussion earlier this year. So the management team at Sanderson Farms is obviously motivated to try and sell this company.
Yeah, fair enough. And I'm guessing by the fact that you have a position, you don't see the regulatory approval being an issue?
It could be, but I'm not overly concerned. And the reason I'm not overly concerned is because if this merger goes through, they will still only be the third largest producer in the U.S. There'll be two companies that are still bigger than them. So for regulators to come in and say, well, you can't be this big, but then let these two other companies continue operating would seem very odd to me. It would seem contradictory. And it could happen for sure. Stranger things have happened, but that would seem very odd. And as a result, my guess is that the regulators approve this.
Yeah, no, it makes sense. Well, hope that works out. I mean, what if the deal does fail, though? I mean, do you have a...
Well, if the deal fails, in most cases, when deals fail, the shares fall hard. And merger arbitrage or M&A investing like this, that's the big risk. The reason I actually took a position in this company, though, and the reason I was, I guess I would say, confident enough to publish an article about this publicly was, I think if the deal falls through, I'm comfortable owning it. And I'm not only comfortable owning it, but I'm comfortable owning it at the valuations where I bought it. And it's very rare in my experience to find a company with those two features. I invest in M&A deals regularly enough. At any given time, I might have 2 to 10 on the go. And generally, I categorize M&A deals that I come across into 3 groups. Companies I'd never own, companies I'd want to own, but not at the current price, and then companies I would want to own and at the current price. And naturally, I just avoid the first category of companies entirely. The second category of companies I'm a little skeptical about, or I'm cautious, and then the third category I will invest quite heavily, and that's how I think about them. And with Sanderson Farms here, I'm comfortable owning them.
Okay, well, that's interesting, and yeah, I like the methodology you've applied to this sort of unique and risky area of the market. That's great. So, just looking at Sanderson Farms stock, though, I'm surprised you would be holding this. In that, if the deal fails, as you say, it's not really one of your typical Contra type stocks. I mean, can you elaborate there a little bit?
Yeah, so it doesn't look like a Contra stock. The chart is very high and it's done quite well. So Benj, for example, I can't imagine him being happy owning this if the deal fell through. I've never asked him about it, but that would be my guess. The other features I like about this company, though, when you peel it back, is the valuations are low. Insiders own a lot. The founder's grandson, for example, is the CEO today, so it's been tightly family controlled for a very long time. The financials are great, and the real kicker is food prices tend to go up with inflation. So if inflation is persistent, this should be a good hedge on inflation. So I think, given all that, I think the business prospects are good, and I'm happy owning it, and that's kind of why I wrote about it. I don't write about M&A a lot on Seeking Alpha, but in this case, I'm comfortable doing that.
Interesting. Well, it sounds like a good setup. Sounds like you'll win either way to some degree. So.
Yeah, well, I hope so. We'll see. I mean, I could be wrong. Maybe I'm super wrong, and you can tease me all you want in the new year. And yeah, who knows? We'll find out soon enough. I should also mention, though, for anyone thinking about M&A, and if they're new to this topic, I would gently say it's not for the faint of heart, and a lot can go wrong with it. So if this is a aspect of investing you want to learn about or get involved with, I would read a lot about it first and make sure you understand all the potential things that can go wrong with it.
Yeah, true. I mean, even when a deal fails, I mean, a stock can fall more than is reasonable sometimes, just simply because the deal's failed. So switching gears a bit to something that isn't in the M&A crosshairs. What do you think of Orange Telecom these days?
Yeah, definitely not in the M&A crosshairs. I can't imagine the French government ever allowing Orange Telecom to be taken over. That would be mind-boggling. To answer your question, though, I like Orange at these levels. I think the valuations are low and they're overall pretty good. I would also say that the organization is a company that we know pretty well. We've invested in it or had a position in it in both portfolios for over a decade now, or nearly a decade now, I should say. And unfortunately, it's come all the way back to where we first purchased it. So it hasn't done anything over the past decade except spin off a great dividend, although it has traded much higher over the past decade. And given that, I sometimes consider it for personal accounts or family members, but I haven't actually taken a bigger position in it recently.
Okay. So is there any recent news, or why do you think it's back to where it was a decade ago? What's the cause there?
Yeah, so one big news item recently is the longtime CEO, who's been there ages, resigned following conviction of complicity in a misuse of public funds case. And this misuse of public funds case goes back well over a decade now. It was at a time when he wasn't involved with the company. And it's pretty ugly. It involves a lot of high-profile figures in French society. And I think he just, as soon as he was implicated in this, he just said, all right, I should pack it up. So that's the big news there. There's no shortage of people who I'm sure would like to fill his shoes, though. So I'm not very worried about them finding a competent CEO to take this over. And I would also point out that because it's such a big organization with operations throughout Europe, the Middle East, and Africa, many of the important decisions are made on a lower level, further down the organizational hierarchy. So that's the major news there. There's been a small operator they've bought in Belgium, and the Q3 numbers were released, though nothing looked majorly out of whack there. The outlook is in place. The dividend is good. So I would say the major recent news is the CEO news.
Right. Okay. Good to know. Yeah. So definitely one for subscribers to keep an eye on. Anyway. Good. So turning to a broader question here, we have a subscriber question just on the airline industry broadly. What are your thoughts? It's certainly beaten up still. So.
Yeah, I sort of have companies I'm looking at in the airline space. I would say sort of because, they're pretty much all on my watch list, but it's very rare for them to make it high up on my watch list for me to consider them closely and get excited about. And every time they do get high up on my watch list, they're competing against other names. And so far, I've always found more interesting sectors or companies or ETFs or whatever to consider instead.
So why don't they get you excited though?
Well, generally speaking, the answer is balance sheets. A lot of them carry significant debt loads, or they've engaged in dilution, or they've done both. And that combination, it's just really hard to get excited about that. And I can see a case for them. I can see a contrary case for them. I can see a case for owning them. But, they are competing against other ideas. And so far, they haven't outcompeted the other things I'm looking at.
So, of course, during the pandemic, they've been very contrary at times.
Yeah, they have been. And, we have had this question quite a bit because, we're known as contrary investors. And you're right. At times, this industry, along with cruise lines or movie theaters, they have been as contrary as you can imagine. The revenue hit that these industries have taken, especially during the onset of the pandemic, was just enormous. The income statements got crushed. And I think without government help, without government support, these companies would have gone bust, or a lot of them would have gone bust. But, I see that, but at the same time, I'm still just focused on balance sheet strength first and foremost. So that's what I think about.
Yep, fair enough. Okay. Well, yeah, you mentioned their government support. Does it? I guess it doesn't give you more confidence at all that they sort of have that implicit government support behind them at all, does it? Or...
Yeah, that's a good observation. I would say the implicit government support is a factor. All arguments about ethical considerations or moral hazard aside, when we're investors and when we're looking at companies, it is a factor we think about. And in the past, for example, we invested in Bank of America, and thinking that the government would step in was an element to that thesis. Same with Banco Santander or Credit Suisse or the regional banks in the US after the financial crisis, or even the Greek ETF we have a position in. When you look at that Greek ETF, a lot of its weighting is in financials, and they have an implicit government backstop. But at the same time, balance sheets, they still really matter. And even if a company gets bailed out, it may come at the expense of shareholders. There may be some nasty conditions put on shareholders or owners. And, if I looked at everything that had an implicit government backstop, my portfolio would be full of tons of crappy companies with awful balance sheets. And I don't really want to do that.
Yeah, and I guess a bailout at $1 doesn't feel too good either, does it? Okay, well, thanks, Phil. I appreciate that. I hope our subscriber is satisfied with that answer. So I know you don't want me to ask you this, but what are your thoughts on inflation here?
Yeah, I knew that was coming, I guess. How can't it? I would say inflation looks pretty bad at this point, and unfortunately, I think I would argue fairly firmly that the central bankers and the politicians are continuing to throw fire on this, or fuel on the fire, I should say. And I know they're talking about we'll rein it in, we'll do what we need to, but they really aren't. They're going in the opposite direction. Deficits at the government level are huge, and the central bankers in particular, they're still engaging in quantitative easing, at least they are in the US. Interest rates are still at record lows, and CPI is at, call it 4.5% to 7%, depending on which country we're talking about. And to have inflation that high and have interest rates that low just seems like a huge disconnect, in my opinion. And at this point, I think central bankers have a bad case of groupthink, or that boiling frog syndrome, or something like that. And I think they're just a bit out of touch.
policymakers from the past would be rolling over in their graves at the moment, I think, if they saw sort of the disconnect between things. Yeah, I mean, it just does seem like central bankers are a little bit out of touch at the moment. Do you think that Canadian and American citizens are feeling the pinch of inflation yet, though?
I would think so. I mean, when you look at the inflation number and you look at the categories which are going up, there are things like rent, energy, transportation, food, big ticket items like cars, and these categories going up, that's a big deal because this impacts everybody's life. Those are important categories to just living out your life. I mean, it's hard to live a nice life if your rent, energy, transportation, and food costs are all going up at the same time. And then I would also point out wages are up, but they're not as high as inflation, so that hurts. And then the unemployment rate is down, which is really nice to see. But labor force participation is not. It hasn't really recovered. So there are a lot of people out there who, for whatever reason, they are not even trying to get work. And those people, they're not even making a wage that can inflation adjust or have it rise over time. So my guess is they're hurting. And then finally, our society is aging. There are more people who are hitting 65 who are thinking of retirement. And as retirees will know, you generally live on a fixed income. You generally have a pension, and that pension is invested in things like bonds, which are traditionally safe. And as a result, I think that that people are feeling it. I could be wrong, but it just suggests to me that people are feeling it. And I could then argue that this might be why we're seeing things like Biden's economic approval rating drop, or other things like consumer sentiment drop as well. So yeah, long story short, I think people are feeling.
Yeah, no, fair enough. That makes sense. So what can people do to help offset these inflationary pressures on their personal finances?
That's a great question. And to shamelessly plug here, I actually wrote about this topic on my hobby website, and the title of the article was "How Do I Protect Against Inflation?" And I spoke about 4 things really. And the first thing that I think almost anybody can try and do is stay employed or stay in the job market, because at least if you're in the job market, your wages should go up with time. And same if you're a business owner. If you're a business owner, your sales and your earnings should go up over time. Whereas if you elect to go out of business or close up your business, or if you elect to go on unemployment, eventually your unemployment benefits will run out, and then you'll be in real trouble. So that was the first thing I mentioned. I also talked about reducing expenses, which I hope needs no explanation. Paying down debt, which again I hope needs no explanation, though interest rates going up mean you pay more for the debt. And then finally I talked about trying to invest wisely, which is obviously easier said than done. But I just pointed out in the article that cash is generally pretty bad. Bonds aren't much better. Stocks and real estate do okay. And then commodities or commodity-related investments do best. But I digress. And if people are interested, they can always go check it out at mymoneymoves.ca.
Perfect. Well, we'll put a link in the show notes then. It sounds like something that would be worthwhile for people to spend a bit of time reading. Good article. So, do you think it's going to slow down at all at any point? I mean, where are we going here with it?
Well, I sure hope it slows down. If it doesn't slow down, I think we're in trouble. If you go back to this time last year, inflation, call it 1%, which is roughly where it was, and now it's, say, 5 to 7%. So that's quite a jump in a year. If it continues at that rate, it means that this time next year, when we do a video like this, it might be double digit, which would be really, really bad. And high inflation can be as detrimental as an economy in a serious recession or as an economy in a financial crisis. So I really hope we don't go there. It would be a pretty bad thing that I hope we can avoid.
Yeah, no, definitely. I'm just wondering, why do you think all the stimulus that came in 2008 did little to spur inflation, and yet this time around in 2020 we've got, we're seeing it. What do you think there?
Yeah, that's a fantastic question, and I wonder that too. And I suspect over the next 20 years, many grad students and master's students or PhD students in economics will make really good papers out of this question. And it seems to me, just on the fly, looking at it in real time, there seem to be a lot of differences between now and 2008. Like the supply chains today are broken. They're just broken, and they weren't in 2008. Pandemic restrictions are a big factor. Bad weather, I think, is a factor too. If you look at BC right now, we've had a summer where infrastructure was destroyed, then we rebuild it, and then it's destroyed all over again this winter. So that hurts. And then the scale of the stimulus was much bigger versus 2009. The quantitative easing was bigger. The deployment at which federal deficits were rolled out was much faster. And then the nature of the stimulus was different too. So I think all of those could be factors. I'm probably missing others, but yeah, I imagine a lot of aspiring economic students are going to be tackling this question in the future.
No kidding. Yeah, absolutely. It's a lot of fodder there for sure. So you said the nature of the stimulus between 2008 and current. Can you kind of build on that? The nature.
Yeah, I could build on that, and what I would just say is that in 2008-9, the stimulus went right into banks and making sure the loans were whole and that the banks didn't collapse. The money that the government spent didn't go to consumers. By contrast, that's exactly what happened in 2020. The stimulus didn't go into banks. It went straight into the pockets of people. And those people, on top of getting money, they weren't working. So I think you had two things happening. You had people who were able to maintain their purchasing power and their consumption activities, but they were no longer contributing to producing the products that other people were going to be consuming. And I think that created a super out of whack supply and demand imbalance. And I think that imbalance is really, really pronounced, and it's a huge difference between 2008 and the present day.
Sort of like if everyone was on universal basic income and nobody was actually working to produce anything, you'd have a pretty distorted system. Yeah. Okay, so you're contrarian. So tell me what the arguments are for deflation here.
Well, deflation is tough to imagine, but that's actually a good question, and I do try to think about that. And the thing I've thought about is if a large asset class were to implode, that could do it. That could end inflation or at least bring it way down. I know our fiat currency system is geared towards inflation. That's its bias, but a large collapse in asset prices could do it. So right now, everybody is talking about Evergrande collapsing and potentially taking down the Chinese real estate market. And if that reverberates through the economy, I think that would be deflationary. It's hard for me to imagine that asset class imploding and it not being deflationary because there's so much debt tied up in it. It's such a big asset class. I mean, China has 1 billion people plus. And the Chinese construction industry, which is mostly real estate, it consumes most of the world's raw materials. So that's the deflationary argument to me. And yeah, I guess we'll see what happens there in China.
Yeah, no, very, very good points. So yeah, great discussion on inflation. Appreciate that, Phil. We're running up on time here. So any closing comments you'd like to make?
Well, I would say thank you, Todd, for doing this and taking the time, and thank you to everybody for tuning in. And we hope you're enjoying the YouTube content. And to our subscribers out there, your next issue of Contra the Herd will be in the mail the week of the 24th.
Perfect. Okay, great. Well, thank you everyone for joining in. Thank you again, Phil. We'll see you next time. Hi, everyone. I hope you enjoyed today's episode. If you'd like free access to our paid subscriber content, just click the link here and enter your email address here. And don't worry, we won't spam you, but if Contra does ever offer a major discount to the newsletter, we'll let you know. Otherwise, you'll just be receiving our premium video content through this channel. So we look forward to seeing you there. Happy investing.